Hello, this is Peter, and I wanted to show you how to enter your orders on a Fearless Strangle. Now, this is a fantastic trade. It can really make us a lot of money during volatility events where it takes a lot of the fear out of the trade because we can make money both ways. But the biggest amount of feedback I'm getting from people is, gosh, how do you enter that trade? There's a lot of different legs, there's different dates, there's different expirations. Seems kind of complicated. How do you do it? So let's take a look at that right now on a fairly complex Fearless Strangle, and you'll see it is not that difficult. So let's first take a look at, and this is a trade that's designed to take advantage of the election. So if you're looking at the dates, your volatility event in this case happens to be November 3rd, and this could be, you could also do this with an earnings announcement, an FOMC announcement, anything that's really going to move the underlying. So in this case, we're trading the QQQ, and we want to sell the call side and the put side, and we're going to start with the October 30th. Now, really important point here. When you go to place this trade and the market's open, you go to place this trade in the morning, take a look at which direction the market is going. So if the market is going up, you want to place your call spread first. If it's going down, you want to place your put spread first. The reason is as the market heads in a certain direction, it's going to make that side more expensive. If the market's going up, it's going to make your call spread more expensive. If it's going down, it's going to make your put spread more expensive. So basically, we want to get that one in the bag. We want to get that one secured pretty quickly, and then we can really take our time on the other side, because the other side is kind of getting cheaper as the minutes go by. So let's just assume in this case that the market's going to jump up and it's going higher, so we want to get our call spread filled. So what we're going to do is we want to sell the October 30th 300 calls. So let's scroll up to the 300 here, and we right click, and then this is going to be buy, and we're going to go over here to our strategy. And this could be a calendar, this could be a diagonal, it could be a strangle, it could be a lot of things. But to make it efficient, we're going to click on diagonal. So you click on that. One of your legs is going to be correct. In this case, it's the sell leg. So we're selling the October 30th 300 call. Now, fortunately, because of these little drop-down arrows in the corners, we can modify the other side. So what do we want to buy? In this case, we want to buy something that's closer to the money and gives us a little bit more time. So there's going to be a $10 difference between the strikes in this case. So we're going to go down to the 290. So you do this drop down, and then you just scroll up till you hit the 290. And we have this nice $10 differential here. We also want different dates. So in this case, we want these two expirations to be almost a month apart, because our idea, our thesis is that after the election, the market is going to very possibly, once all that risk is removed, maybe there's some stimulus, chances are good the market's going to go higher. So we want a whole month for that market to go higher without another option impeding our upside potential profit. So you click this little drop down. We want to go all the way out to November 27th. So you select this. You can see November 20. Oh, that's 20th. We want the 27th. Oh, this is the 27th of 2020. So we click on that. So we've got this one. The one that we're selling is expiring fairly quickly, and it's fairly out of the money. And then this one that we're buying gives us a lot more time, almost a month more time, and it's closer to the money. So our plan is to make this one our money maker here. Now we can see that this is a $7.95 debit. Well, here's the problem. During the heat of battle, the market's going up and you're watching this thing climb. So you're going, okay, it's $7.95 now, but by the time I get this thing entered, what's it going to be going for? So you might want to click an extra couple of pennies, maybe a couple more. It just depends on how fast the market's moving. Do something where you're pretty sure you're going to get filled without, giving away the farm. And if everything looks good, you hit confirm. The most important thing is that you look at this, you read this green bar right here and make sure you're doing exactly what you want to do. And in this case, we are, so we click send. Okay, whew. Got that one in the bag. If your audio is on your computer, you're going to, when you get filled, you're going to hear that little ding. That lets you know that that one's in the bag. Now we can just relax a little bit and get filled on the other side. So in this case, we can see that the QQQ, the price is around 284. And so we want to drop down and buy we're going to buy the 280, we're going to sell the 270. So we go up here, and once again, counterintuitive. I know we're going to sell the 270, kind of counterintuitive, but we're going to hit the buy button here. We're going to go once again over here. We're going to hit diagonal. And what do you know? This bottom leg is correct. So this is the October 30 expiration. It's the 270, but we want to buy the 280. So we need to change this strike up here. It defaults to 269. Don't worry about that. Just hit this little arrow in the lower right and then scroll till you can get the one you want, which in this case is the 280. And in this case, the strikes or the expiration dates are actually correct. So we're selling the 30. We're not buying the November 27th expiration because we don't want to spend all that money. Our theory is if the market is going to crash after the election, it's probably going to take place, right after the election. And so we're just giving ourselves 3 extra days after the election to make money on the downside if the downside happens. So this one is actually correct. This gives us 523 as our debit, our cost on this. Maybe the market's heading up a little higher. Now, in this case, if it is heading a little bit higher, you do just the opposite. You lead it a little bit. So you take that down a little, try and get it for a few cents less, and then go ahead and hit confirm and send. And once again, read this green bar and make sure that you're selling what you want to sell and buying what you want to sell and at your correct strike prices. So you want to buy the one that's closest to the money and giving you a little bit more time. You want to sell the one that's further out of the money with a little less time. And that's a really nice offset to our cost. Obviously, our goal is to get our cost on this trade overall as low as possible, which gives us more upside potential profit. So if all that looks good, you hit send. You can, of course, go over here to the monitor tab and click on that and make sure all your trades look good. And if you don't get filled right away, you can go in there and modify it a little bit and get a fill on that. But the idea is to get the lowest cost you can, enter this fairly efficiently, don't make any mistakes. And the way you do that is just approach it nice and calmly. And I recommend having your legs actually written down on a sheet of paper right in front of you so you don't get mixed up. Do this a few times and you'll see that it's not as hard as it initially looks. And the neat thing about it is it really covers us in both directions, lowers our cost basis on the trade, and gives us the best chance to profit on a high volatility event.